Hello, everybody, and welcome to the Anew Advisors webinar education series. Thank you for joining us today. My name is Liz Notling, and I'm the Director of Operations for Anew Advisors. Today, our webinar will be focused on 457s. Glenn Colwell and Nick Schneider will be presenting. Just a few housekeeping things before we get started. Today's webinar will be recorded. During the presentation, you may ask questions via the chat button. Otherwise, there will be a Q&A at the end for any questions that were not answered. So without further ado, please welcome Nick and Glenn.
Thanks, Liz. We can start in right away. So the topic for today is 457s. And it's a great piece for an educational because I think a lot of terms that are being familiarized with in the retirement plan space are traditionally 401ks or 403bs or profit sharing or pension or ESOPs, etc. So this is just another IRS code that defines a retirement plan sponsored by typically a governmental agency, but there is an additional 457 that sometimes private sector uses to compensate certain levels of management or highly compensated employees for more of an attraction retention tool. We'll touch on that briefly, but the majority of this particular webinar is going to be on the 457 that's applied to governmental agencies for employees of municipalities. If you want to move on, Liz. Thanks. Here's our team. So again, I'm Glenn Colwell, Managing Director, and then we have my colleagues, Anthony Zilli, Director of Business Development, Nick Schneider, who is also on the phone, Director. He's kind of our internal, runs investment analysis and reporting and monitoring. We have Mike Bongiorno, Director of our Fire Services. So anyone on the call that is part of the fire service industry, whether you're part of a local leadership or a member or a chief, please reach out to Mike and introduce yourself. He'd love to hear from you. And then Sean Lauda is the Director of our Law Enforcement. Again, if you're part of a union or local, a member or an individual law enforcement agency representative, please reach out to Sean and introduce yourself. And then Liz, who opened the call, Director of Operations. Just share with you our mission, vision, and values. This is on our website. What I continue to say, what I'm most proud of is in our value section is our grit. We hold each other to a high standard and we're constantly questioning each other about our advice, about our deliverable, and about our best practices. So we're trying to make sure that we're constantly evolving to the benefit of our current clients. History of Anew, it was formally put together in 2020, but it really has extensive roots much further back than that. So this is my 23rd year in the business of investment management and investment advice. And my colleagues, Anthony Zilli at 15 plus years and Nick at 12 plus years, really kind of the founding members of this Anew Advisors. We've all worked in the financial industry for a long time, but really started to focus more on very specific areas starting in 2020. The two primary areas is first responders, and then secondly is private sector business leaders. So that's kind of the formalization of that, and we just rebranded in 2020 to call it Anew Advisors. Our education calendar, so this has been a commitment to our clients and to our prospective clients, is to just really start to educate them on a more often basis. We started publishing our calendar this year. We've always done education, but what have been asked for by many different entities is, can you provide an education calendar and can you provide notice so we can distribute it to our employees or members? So here it is. And again, this will be emailed out in a monthly fashion as we come up to our next particular webinar. So this month being June is 457s. We do recap the quarter market and economic performance at the end of a quarter. So at the end of June is the end of the second quarter. So July will do the second quarter wrap up from a market and economic standpoint. And again, we do that at the end of every quarter. So you see October and then January, then April. So topic du jour of what we're speaking about today. So there's really two 457s. Again, it's an IRS code. There's a 457B and a 457F. Both of them are considered deferred compensation plans, and they're tax advantaged to the employees at different levels. So traditionally what you have is the B is available for local government agencies and typically nonprofit agencies. and the F is more of a private sector, although some public sector can use it. It's really meant as an attraction retention tool. So what we're going to speak about today is the B. So think of it much traditional, like a retirement plan, like a 401k or 403b. You're going to have contributions in from an employee through payroll deduction, right? And so Nick will go into that a little bit further. If anyone has questions on an F from an attraction retention standpoint, or to segregate out a certain class of employees for an attraction retention, please feel free to reach out to us. Go ahead, Nick.
Yeah, so what we're going to cover now a little bit more in depth, like Glenn said, is going to be that 457B that's typically available more to public sector employees. So what are kind of the steps and how we use this 457? One of the first things you're going to have to do is figure out who the providers are that you have at your municipality. So in our experience doing this, some municipalities might only have one option. Some might have up to 5, 6, or even 7 different options. So these are just some of the key names, what we see a lot. You're going to be looking for names like Nationwide, Voya, ICMA or Mission Square, One America. The one that we use is the standard. So the first step is kind of figuring out what your options are going to be. From there, when you want to start contributing, each municipality is going to have their own rules for how they want payroll deduct to happen. Some take it quarterly, some take it monthly. There is some new legislation coming out through the Secure Act that is encouraging municipalities to allow for members or employees to make changes more often. So if you do only have the option to do it quarterly now, I would look out because pretty soon you might be able to change it more often. And the better record keepers will make that easier for your municipality to do that, to be able to change your deductions more often. Inside of those, go ahead.
Yeah, I'm sorry, Nick, I don't mean to cut you off. Just from a level set field, again, the record keeper is typically the employee facing website, right? So yeah, most employees are used to going to their Nationwide or their Voya or their ICMA website to access their 457 plan. So it's kind of that face fronting interaction with the employee.
Perfect, thank you, Glenn. And then once you're in, you're going to really have 2 options, whether you want your dollars to go in pre-tax or Roth. So every 457 will have a pre-tax option. Not all of them will have a Roth. So when you're going through and trying to select which one of the providers you want to use from your municipality, I would make sure it has a Roth option. If you're curious as to why we lean pretty heavily Roth, if you go to our website, we do have a previously recorded webinar on why we prefer Roth and think it's a good option for people. But it is something that if your municipality doesn't provide the Roth option through one of the providers, it is a good question to ask them as to why and try to get one added. So then once you kind of decide, okay, I've got the record keeper, that forward facing piece I'm going to use, what you want to do for payroll, and then is it going to go in pre-tax or Roth? We get into the investment portion. So Liz, I'm going to have you jump to the next screen. So there's really 3 different ways that you can choose your investments inside of your 457. There's do it yourself, you want some help, or you want to do it, or you want someone else to do it for you. So we'll start with the do it yourself option. So when you log in and you go to the investment section of that website that you log into, you're going to see a list of investment options, and they're going to range in returns and what they hold. But the major ones are you're going to get equity funds and ETFs, bond funds and ETFs, and then you're going to see some sort of like cash or stable value investment. So if you want to select your own investments, you have that option. So equity funds, you're going to see probably small cap, mid cap, and large cap, with small cap being the most aggressive, mid cap a little less, and then large cap you're going to see are a lot of the companies you're going to know, right? It's a lot of the ones in the S&P 500 or the NASDAQ. There are going to be a lot of names that you know. And when we build plans, what we're trying to do is give investors an option in a couple of different boxes. So you're going to see some Morningstar ratings. I'm going to go into those in a little bit, but you're going to see small value, blend, and growth, medium value, blend, growth, and same in large. So it's going to be large cap, value, blend, and growth. So you're going to see that they're all going to fall into one of these categories. And when you're trying to build it out yourself, you're going to want probably some allocation in some or all of these categories. And this is where if you're dealing with Doing it yourself, you're going to go through and you're going to pick the percentages in each one of those. And that's where we as advisors, we can help answer questions for you as you go along. But we're also going to show you today how to figure out which one of the investments in each one of those categories might be best for you. The bond funds, a little more conservative, right? In the traditional sense, when we talk about levels of risk, bonds are typically a little more conservative, and you're going to see the same thing. There's going to be categories in bond equity or bond ETFs or mutual funds in a couple of different categories that you'll be able to select. And then the most conservative investment option you're going to see is cash or stable value option. And this is for like if you have an immediate need for it, if you're a little bit more fearful of the market, you can move some of your investments into the cash or stable value. And so that's if you want to do it yourself. You would go through and select those individual investment options yourself. Some people want some help. Oh, go ahead, Glenn.
Yeah, I was just saying, typically on these forward-facing websites of the record keeper provider that's being offered to you, again, whether it's a Nationwide or ICMA or Voya or One America, they might have a portal or questionnaire that kind of helps you narrow down each of these investment options, whether it's an equity stock fund or a bond fund or cash. So it starts helping you develop some type of research to get to the end result to help you pick.
Yep, exactly. So then the second way is if you want some help. In each 457, there should be what are called target date funds. So when you go through your investment options, you might see some that says like Vanguard Target Retired 2025, right? It's going to be an investment name with a number after it. What they're trying to do is manage the investments for you all the way out to a particular retirement date. So what happens in these funds is as you get closer to the retirement date you pick, so if you're going to retire in 2030, you would pick, in this example, the Vanguard Retirement 2030 fund. Because then as you get to 2030, it's going to get more and more conservative for you. So it's going to manage the underlying positions that you hold to be more conservative. And then the last option, for us, it's really important that these solutions are no cost managed account solutions. And this is the do it for me approach. So what these managed account solutions do is they look at the investment lineup available, and then sometimes for a fee, sometimes there is no cost. They will actually build a portfolio for you based on some sort of questionnaire or income that you're trying to hit. They're going to ask some questions about goals, and then they will they'll automatically adjust your investment selections for you. The big thing here again is we like to use options if we build a 457 that are no cost. Some of the big names you'll see might be Morningstar, and they'll do it for a little bit of a cost. So just make sure you're aware of it when you sign up for that, but that will fully manage the investment portfolio for you. Then Liz, I'll have you go to the next screen. So this screen is kind of twofold. This is talking a little bit about how you can go through and try to select the investment options yourself, but also how we benchmark 457 plans for cost and performance. So I'm going to have you focus on this very first box here where it says large value. So this goes back to some of the boxes that we want to fill, right? So we want to look at performance and costs when you see these particular pages, and you should be able to find this information in the investment section of any one of your 457 options. So as we look through, you can see there's annualized returns for 3-month, year-to-date, 1-year, 3-year, 5-year, and 10-year or longer. So that's just the actual performance of the fund. The next category over helps narrow it down a little bit quicker. And what you're going to see is it says percent rank. So what I want you to think of is like a golf score, right? We want to be closer to 0 or 1, right? Because that means that we're in the top 1%, top 25%, or top 50. So when we look at funds, we want to try to choose funds that over the 3, 5, and 10 year are going to be in the top 50%, because that means that they've been able to show, regardless of cost, that they've been able to perform over longer periods of time in multiple market cycles. So if we look at this Vanguard Equity Income Fund over the 3-year, it's in the top 59%, 5-year top 28, and 10-year top 16. And those star rankings underneath it are provided by Morningstar. So Morningstar is a very large research company in the industry, and they give star rankings to basically indicate their level of quality. So then when we go down to Mission Square, their equity income fund, you can see over the 3-year, they're in the 62nd percentile, 5-year 84th, and 10-year 91. So objectively, you would look at these two and just say, based on performance and Morningstar ranking, you can say that you'd be better in the Vanguard Equity Income Fund than you would be in the Mission Square Equity Income Fund. The next thing you're going to look at right next to that is the expense ratio, because we know that over time, expense ratios can play a big part in returns. So you can see on that Vanguard Equity Income Fund, expense of 0.19%. And in that Mission Square, that 1.3% is higher, right? So again, lower can typically mean better, but we ultimately want to look at performance as well. But that should give you a level set if you want to be able to pick investments yourself. So you'll be able to do this like this sheet shows, going through each one of these individual categories, looking at the investment options that you have available. And then when we benchmark, this is a big part of what we look at, right? We're going to put this all together. So say you have a Nationwide, a Voya, and a Mission Square or ICMA all available to you at your municipality. How we'll help is we'll go through and we'll look at each individual investment at each one of the providers and do a comparison of all of them versus what we might provide as well as an option. But what that'll do for you, no matter what, is you'll be able to see quickly and clearly across all your options, across all those front-facing websites we talked about, which one will have the investment options that best fit for you and help you select the provider basically that you want to use to put your payroll deductions to. So that's a big part of how we can help. And then for the municipality, we work on helping them save on costs and administration time and workload, as well as making sure that they're benchmarked, right? So we've seen some of these where none of the features of the plan or the cost, the performance of the plans have been reviewed, and sometimes up to 15 or 20 years. So sometimes it's important for the municipality as a fiduciary to just make sure they're going through and they're in there doing their due diligence to make sure that everything they have available is up to par too.
Yeah, and the other thing I would say, thanks, Nick, is like even if you look at like the large value or the large blend or the large growth, again, those are all these large companies, U.S. equity stock as investment options. What you'll see in this is an actual real lineup of a law enforcement agency and fire service agency under one municipality. This were their investment options in Mission Square. It's overlap. Like you don't need 3 investment options in large value. You don't need 5 investment options in large blend. So part of our job is not only to look at the performance and the cost, but really to narrow down the lineup to be able to make a prudent decision as well as a simple decision. A lot of times you get just frozen in your investment decision-making process because there's too many choices or too many options. So there tends to be a lot of overlap if you don't have an advisor, a third-party independent investment advisor like ourselves that are constantly monitoring and overlooking the lineup.
Yeah, and there's research to support that. So Fidelity, one of the biggest record keepers in the country, put out a survey, this was maybe 3 years ago now, that once you get over 27 investment options, participation starts to go down. So when you look at first responders, but not only do they have to choose between the investment options at one record keeper, they have the investment options between maybe 3 or 4 record keepers. It can be a daunting task, and it hurts members because it makes it harder to actually use and select a 457.
Yeah, it's a good practice to have them benchmarked just to help understand exactly what you have available to you.
Yeah. Next slide, Liz. So that was our high-level overview of 457s, how we use them, how to look at the investment options. Do you have pre-tax? Do you have Roth? Those are all good questions to ask. So are there any questions for us that you'd like to have answered? And you can use the Q&A button at the bottom, or you can, there's chat, then you can raise your hand and Liz can filter the questions in.
Okay.
I don't see any questions coming in. We are always available. Otherwise, Nick or Glenn, is there a question that you think some people should be asking and we're not?
I guess the other thing I would say is where we get taken up a lot on an exercise is, okay, you have your 457, you're contributing to it. How do you know if you're on track to retire? So we do run through our roadmap exercise where we'll ask you for a copy of your pension statement or pension projection. We'll ask for a copy of your 457 statement and any other assets you want to consider, whether it's IRAs or spousal assets. And we'll plug it into our roadmap software and we'll show you where you sit exactly on track to be on track for retirement, or if you need to make some adjustments along some of those plans. That's a free service or no cost service that we provide to members, especially those of the locals or states that are engaging us and helping them manage their assets.
Yeah, and on that, that's where we can really add some value to with these 457s and providing some guidance, right, as to what to use. Because again, there's just so many options typically for each municipality where it can be hard to pick which one you want to go with.
We have some questions coming in on the Q&A if you wanted to look at those.
Yeah, I just pulled it up. Thank you, Liz. So I'm going to start with the first one. Are there different rules for 457 Roth versus traditional Roth? No. So if you're provided a Roth option inside your 457, the only rule is the dollar contribution level. So if you're under the age of 50, you can put in a certain dollar amount. I think is it 22,000 this year, Nick?
In the Roth, yeah.
So that's either in traditional 457 bucket or the Roth bucket. If you're over the age of 50, you can have catch-up contributions. It's just the way it's taxed. So if you put it in pre-tax or traditional, you put the money in and it's tax deferred. So you're not taxed on it now. And then when you do pull the money out, you will pay taxes on it in the form of federal and state income taxes. So that's the difference. If you put money into a Roth 457 bucket, if you will, through your employer plan, you'll pay taxes now, but it grows tax-free as long as you have it in there 5 years and reach the age of 59 and a half. So hopefully that answers the question.
Yeah, and the big difference is obviously is the contribution limits, right? I want to emphasize that because you can stash away a significantly higher amount if you do it through your 457. So if you have a Roth outside of your 457, like at a Charles Schwab, limit's going to be 6,500, I believe, for this year. But if you do it inside of the 457 in that Roth provision, you can stash away 22,000 in Roth dollars. So you can get a bigger bucket of tax-free growth by doing it through the 457.
Yeah, and if your plan doesn't provide a Roth option, your municipality, I think you should ask them, or if you want to reach out again, if you're in law enforcement, reach out to Sean Lotta, our business director officer for law enforcement, or if you're in fire services, Mike Bongiorno. And if you don't have those numbers, shoot us an email through our website. We can get you in contact with them, but they can help lead that discussion as well. Next question, any changes I should make to investments after retirement? Yeah, I think it's always a good idea that as you're getting closer to retirement, probably within the 5 years out, you should go through a roadmap exercise that we offer. So we should look at your overall pension, your 457 and any investment assets that you have geared towards retirement to make sure not only are you on track, but do they need to be optimized to help you replace income in your retirement years? So I think there probably always are some recommendations, right? You get older, lifestyle changes, spouse may work or may not work, you may have kids, you may have extra expenses. That's all predicated on your own individual circumstances, but we're happy to go through an individual roadmap with this person. So please feel free to reach out to us. Lastly, I touched on this a little bit. How do I pay taxes on the 457 money once I start pulling it from the fund? It's just a withdrawal. You separate service from your municipality. And once you retire, you can take withdrawals. But again, you are going to pay some tax on. If it's in the traditional bucket, you'll pay Fed and state. If it's in the Roth bucket, it can come out tax-free, again, as long as it's in there 5 years and 59 and a half. So you would do a distribution form from your record keeper. So
yeah, just to add a little depth to that, it depends on the record keeper, right? A lot of them, when you fill out their form, are going to give you an option on how much taxes you want to withhold if it's coming from that pre-tax bucket. So it's a good conversation to have with an advisor or an accountant, like, hey, how much should I withhold coming out, right? So you're going to select that on the distribution form when you start taking money out. And the nice thing is pre-59.5 coming from the 457, you won't pay the additional. In Wisconsin, it's a 10% federal and 6.5% state, right? But that 10% federal penalty is no matter where you are pre-59.5 if it's coming from an IRA. So the 457 registration has value, as you can avoid an excess penalty if you're under age 59.5. And that's why when we go through these roadmap exercises, if you're not at that age yet, we always want to make sure we leave some dollars in that 457, because up until 59.5, it saves us on some taxes.
Thanks, Nick. All great questions.
Yeah.
I think we answered them all.
Yep. Yeah, so if there is no more questions, thank you, everybody, and feel free to reach out to any one of us or the business development officers directly.
That concludes our webinar.